All right, well, thanks everybody for joining us today. We're going to be running a webinar on inflation modeling and how we're going to be able to handle that within the Oracle EPM Cloud Suite. So before we dig in, I want to just call out a couple things that, as organizations are starting to think about the annual plan, their budget, how are we actually handling inflation? Inflation is one of those things that is really foreign to us at the current point in time. We haven't had to deal with inflation in over 30 years, and as we start to think about how we're communicating to executives, how we're building our models, we need to be able to tell the right story. And because this is new, not necessarily having all of the data at our fingertips and breaking out what the impact of inflation is to our business models is going to be very detrimental. So this is really trying to make sure that we understand the art of the possible and how we can set up the systems today to make sure that we give that information. We arm those people with the right information to make decisions. So delving right into it, we're going to be talking a bit about what is the problem statement here, right? What exactly is the problem? We're going to then walk through the situation from a vision perspective, a strategy perspective, and a tactical implementation perspective. We want to make sure that we have not only the transformational element, the functional element of what we're trying to accomplish, but we also want to make sure that we understand the strategy for how we want to do the implementation from a functional lens, but also from a technology lens as well. So there's going to be quite a bit of information for all areas of business, down to the absolute tactical of how we might be able to implement this. So a little bit about me before we start. My name is Matt Rawlings. I'm the EPM practice lead here at InnoApps. I've been in the EPM space now for coming up on 2 decades. And aside from just doing implementations, I also have around 9 years of finance transformation background as well. As we start to dig into what really a good implementation revolves around, specifically as it relates to inflation modeling and modeling in general, you have to make sure that you highlight all of the relevant areas. And a lot of these things are coming from finance transformation, right? Making sure that you have the right concepts from a driver-based planning perspective. What is the art of the possible on how you might solve this through your chart of accounts? What is process design? Where are the handoffs happening? What organizations and what stakeholders are going to be dependent on this information? And some of the other items in terms of what is your reporting strategy and what questions are you trying to solve? How does this factor into your long-term roadmap of understanding what predictive planning is? And of course, how are you starting to factor in things like hedging in FX? Because inflation impacts currency too. The impact is really on the entire organization from an office of the CFO perspective. And the more that we start to loop in the other areas which may not necessarily have a detailed involvement with financial systems like EPM, the better off that we'll be, right? That might be supply chain, that might be tax, that might be treasury. All of them are important because all of them will be impacted in one way, shape, or form. So a little bit about InnoApps. We're a Oracle only partner, and that is pretty unique in the space. We focus on pretty much everything from a soup to nuts perspective. We do program management. We make sure that we go through change and adoption. We have ERP, EPM, BI, data warehousing, HCM. And when we start to think about design for applications, we're thinking about it from a holistic perspective. Every product is important. So as we start to tackle these different items, we're focusing not only on the implementation and the usability, but also from a managed services end as well, which is, it kind of wraps up what our total offering offers. Now, delving into the problem itself. Noise. It boils down to noise. As we try and understand what our business plan is, what our targets are, how can we become operationally efficient, we need to try and remove as much noise as possible. The more noise that exists in our business plans and in our forecasts and in our actuals, it becomes incredibly difficult to be able to tell that story to executives. And each different use case within the organization for what you might use systems for is impacted. We're going to talk about quite a few of these in this particular webinar here, but the story that we tell people needs to start being predicated on the information available at our fingertips. And if we use the first one, and I think this is probably the easiest to kind of grasp, is pricing. How are we pricing to the market? How are we communicating the pricing to the market? Are we capturing enough inflation adjustments in our pricing? Do we submit too many rebates? Are we giving customers too many discounts? Is this causing a problem? Because at the end of the day, we need to make sure that we partner between FP&A and the revenue groups and pricing to make sure that they have the information that's available. Now, they may not actually have all of the appropriate information from a costing perspective to drive their pricing decisions. And the more that we can provide them with what the inflation adjustments are, the better that they'll be able to recover those costs as time goes on. Another use case, and this is one that really isn't talked about too much, but I think this is something that as we went through the Great Resignation, we need to remember that good talent can be extremely hard to find. So there is definitely going to be an impact on employee retention as it pertains to inflation. So as we start to think about things like merit adjustments, as we think about inflation adjustments, are we capturing enough? Or are our bonus pools actually working off of inflation? Are we treating inflation as a controllable cost? Should we? Because if we miss our targets as an organization and that impacts the overall bonus pool, that will impact retention, and that will absolutely impact our bottom line, because without good people, it becomes really hard to deliver. So discussing this with HR and of course all of the other appropriate stakeholders to figure out how to create a good model with inflation in mind from a retention perspective is absolutely paramount, right? Because at the end of the day, with increased turnover, we're going to need to have increased recruiting, increased sign-on bonus costs, increased training, and a decrease in productivity. So understanding how inflation works, if we miss our inflation targets, there becomes a risk to the business in terms of what our bottom line might be due to all of those additional costs that we have. And then finally, at least in the introduction to the different kinds of use cases, we have stakeholder reporting. Are we accurately capturing the types of inflation and how it's going to impact our bottom line? Are we able to, excuse me, coughing, are we able to capture all of that information and present it back? Are we going to arm the CFO during an analyst cost as we're presenting earnings? Are we able to answer those costs from a business model risk perspective to investors and banks and stakeholders from that lens? Because the better that we have an understanding of how we're communicating out to the world and to the analysts, that directly impacts our stock multiple. One of the main factors of what the multiple of an organization is in terms of valuation and share price is strength of the management team. And being able to accurately and succinctly communicate to all of the appropriate stakeholders, analysts, and equity holders is going to directly impact our ability to create shareholder value, or to get additional lines of credit as we start thinking about how we're explaining our business model to banks and how we're protecting our bottom line and our revenue streams and our margin. So when we think about what a cloud implementation is, the system is really just one small component. As we think about what a best practice implementation looks like, it all starts with what the process is. How is the business going to leverage the tool? The tool is really nothing more than a tactical method to solve for particular questions and problems that you have, right? We want to be able to leverage the tool, and the tool might be Excel, the tool might be a cloud tool, it might be a legacy on-premise tool like old school Hyperion that you might be using, but it starts with process. And we need to make sure that we understand how we're going to leverage the tool. Understanding process is incredibly important, because if you start to look at the tool without really understanding the process first, you might skip steps. You might answer questions that have no questions. We might be answering questions that might not be asked during the normal monthly review cycle, right? How are we structuring our reporting? Are we thinking about the monthly and quarterly review cycles? Are we talking about the operational sorts of challenges that you might have in building that into the process, where the system is answering the questions and providing insights that you know are going to be asked to align those expectations? It's incredibly important. And a lot of what we're going to be talking about is in the modeling and data component of this. Now, modeling has a few different terms, right? It has a few different usages in the world. There's data modeling, and there's also statistical modeling, where you're doing forecasting and budget modeling, et cetera, to define the right way and how to calculate things. We're going to be primarily talking about data modeling, and to a lesser extent, forecast modeling here, to talk about how we can represent this data. Because how you're going to capture inflation and where you're going to be providing this transparency is really going to be based on your organization, your industry, what level of detail do you want to capture? And then finally, as we start to look at this, we're going to leverage financial systems to help automate the process. And obviously, as we start to think about, what the risks are, the more that we are adhering to the different reporting requirements that we have, the better. Nobody wants a regulatory risk. Nobody wants any sort of risk of fines from the SEC or another governing body, right? That's just not necessary in this day and age. And again, boils down to enablement. So when we start to think about best practice, right? What is world-class? It's important to think about and define that before we dig in. World-class really boils down to a few things, right? To simplify it, we need to make sure that we do things at the right level of detail, in the right time frame, which sets reasonable expectations to the business based on what the available resources are. So if we're looking at our overall planning calendar and we want to execute our long range plan, and we only have a few weeks to do it, we're very likely are not going to end up doing a bottoms up LRP, right? For every single customer, for every single product, for every single geography. It's typically at a pretty high level to set the strategic direction. We want to do this and make sure that we focus on maybe different classifications of revenue. What is your margin? What are some of the core productivity KPIs and other items like that? We're doing that mostly at a total company level and by different elements, like, for example, segment is traditionally very important. Once we do that, we're going to go into different areas of the planning calendar, like we might set our CapEx next, and then we transition into the annual plan. When we do our annual plan, we want to make sure that we start with target setting. And as we're having the conversations around target setting, one of the core KPIs that we realistically should be talking about are going to be how we're defining inflation for this upcoming year. How is that influencing what our plan is? Telling that story. What is the appropriate narrative? And where do you actually want to set your targets? And what level of detail are you going to communicate whether it's a revenue impact, a cost impact, a margin impact? Where does inflation come into play? And how do we need the financial system to support that? Now, once we do that, we want to go through a target cascade. And a target cascade really is nothing more than, I want to take those top level targets, I want to allocate them down to the lower levels in the organization. And then we want to be able to, we'll call it operationalize. And there's just horse trading there to make sure that you're moving dollars around to reflect operational realities, because allocation methodologies are really just an easy way to set the baseline for what your targets might be. And then you'll go in, and if you know certain areas in the business are going to grow disproportionately to the others, that's where you factor that in. So as we start to think about this and what all of this looks like, what matters is level of detail and materiality. If inflation is 1%, it's probably not going to factor into a materiality perspective. Now, as we start to think about what inflation is and how it's defined, over the course of the past 35 years, we've changed the way that inflation calculates. Back in 2022, if we used the 1981 CPI calculations, we had somewhere around 18 to 20% inflation here in the US. Now, it's different based on different locales, right? Based on the different inflation of energy and commodities, and there's also deflationary elements of different costs and in items within the organization that influence the bottom line. But as we start to think about this and what inflation means and how it works, we need to make sure that we understand what the impact is going to be. How material is it? Do you want to plan inflation in a single bucket? Do you want to break that down into revenue and cost? And then finally, as we start to think about the future and what best practice is going to look like in 5, 10, 15, 20 years, it's all going to be about predictive planning. Predictive planning is based off of data. And if you're looking at, and we'll use 2020 and 2021 as the examples, if you're looking at the COVID years, we're really not going to get an accurate look into what the data look like because of how odd the business cycle was in that year. Being able to remove the noise and normalize based on inflation is going to be incredibly important. You're going to need to be able to do that not only from an actuals perspective, but you also should be looking at that from a plan and forecast perspective as well. And comparing things on an apples to apples basis. So at the end of the day, we need a vision. And that vision is making sure that we have a better data model than we have today. We have not really included inflation in our data model because we haven't had to. However, because of what happened in 2022 and what has already happened in 2023, inflation is here to stay. It's not going away. It is becoming structural. And so there's a couple different impacts that we have as we start to think about what all of this looks like. So we need to provide the appropriate transparency and analytics to facilitate decision-making. And decision-making falls into a few different categories. The first category is going to be internal, right? So what are we doing internally to influence operations and internal stakeholders? Then we have external. Maybe those people are going to be equity holders, right? Maybe you're a publicly traded firm. And then we have creditor types, right? And each different stakeholder is going to be asking similar but very different questions. And we need to make sure that we're addressing all of these questions in each step of the process. What are we doing from a management review meeting? What are we doing from budget cycle adjustments? How are we going to do that? Is this a controllable or a non-controllable cost? What KPIs are going to be influenced? Do we need to look at KPIs including inflation and excluding inflation? Because that truly is out of our hands. And as we start to look at business impacts and how we are trying to address this from an operational lens, what are we doing to hedge? Now, hedging is very common in the treasury space. This isn't really a treasury application. Historically, it's more of an FP&A application and an operational application. But as it starts to think about the strategy going forward, hedging is going to be important, right? Are we hedging in any way? Are we partnering with Treasury in the right way? So now that we've laid out the vision, and that has to do with transparency and having the right amount of analytics to support decision making, what are the major different approaches that we can use to solve this from a strategic lens? So the first and easiest way to be able to tackle this is going to be by setting up either separate accounts or separate cost centers to be able to track inflation. Inflation is going to hit your P&L across the board. You're going to have inventory, it's going to hit your balance sheet, it's going to hit your operational expenses, it's going to hit your overhead expenses, and there's going to be a lag associated with that. It's not always going to hit every single line on the P&L at the same period of time. So how we tackle things like this historically, right, across the FP&A world from a systems lens is let's go back to Hurricane Sandy and other types of one-off adjustments. So we knew that Hurricane Sandy hit, and it hit certain industries significantly more than others. How organizations wanted to capture those one-time costs was up for debate, and how a lot of companies solved for it was they created a separate account in their chart of accounts to capture that. And they captured it as one-time cost, they genericized it, and they booked specific adjustments which were attributable to Hurricane Sandy and other items like that to that account. So they could show that in a single line on their P&L at summary levels. Now, they did not allocate this down to individual cost centers. That was not really the intent, but it helps reduce noise at top of the house by showing what the overall impact is. Now, I don't necessarily think this is the best approach to do this, but it's one of the simplest approaches. And it really helps you if you start to think about, and we'll talk about this a little bit later, but if you start to think about whether this is going to be an adjusted EBITDA add back. Because, and again, we'll talk about this later, but because adjusted EBITDA allows us to back out gain loss from FX, you could argue that gain loss associated with inflation could also be attributed to this. So as you start to think about your treasury strategy and how that was, having a separate account to be able to do this, and whether it is an add back, having a separate cost center to see maybe the full P&L or a separate line item in total. So for example, some real life examples of this would be how you're doing restructuring, how you're doing management transition costs. A lot of times you'll set up a separate cost center for initiatives like that and capture all of the specific items from a, maybe you're allocating rent, you have salary expense, you have benefits, office supplies, etc. You have your whole P&L, and then at the end of the day, you do a reclass out. So that way you show it as a single account on your full total company P&L. And again, that's primarily used from a reclass perspective, just to help with management reporting. You can leverage it to report externally if you so chose, but again, primarily it's on management reporting. Next is price volume mix. Now, it's not necessarily exactly like price volume, or it's not exactly leveraged as price volume mix and in price volume mix, but the methodology and the approach is going to end up being the same. So what I mean by that is leveraging an approach to make sure that you can do an analysis on what is contributing to the change in your margin. Should you include inflation in sorts of revenue walks or cost walks or margin walks? That's really an important question to ask. So as you're telling the stories to executives, are you building your decks? Are you building your presentations and your narratives to executives and the board alike to make sure that you're answering those questions? You have those answers at the tip of your fingertips. So you don't necessarily have to worry about doing all of this one-off analysis. And we'll go into a couple examples later on what this might look like and how you could capture this within the tool, right? Because at the end of the day, when you do systems design, it's incredibly important to start answering those reporting questions first. You start with reporting, you figure out what questions that you need to solve, and then you walk backward. And again, price volume mix is one of those things that as you start to question what is the intent of price volume mix, I think inflation fits really neatly within that. Next, we need to start talking about allocations and profitability. Do you want to allocate inflation impacts down? So that way you can manage organizations on a controllable, non-controllable basis. We talked a little bit about this before from an overall bonus impact perspective, but do you want to hold inflation at the top of the house, or do you want to be able to allocate inflation hedges down so that way you can see if things are being disproportionately impacted, right? Do you want to be able to see what the profitability and the inflation impacts are? Because potentially, depending on your supply chain, depending on how things work, you may have a significantly different part of your geography or segments which are getting hit even harder. And all of those things boil down to answering the question, what do we do from an action plan perspective to mitigate the risks of inflation to our overall business model? How are we protecting our bottom line? And arming yourselves with how this is impacting the detail may help. Now, there's a couple schools of thought on allocations and profitability. One of them is, hey, let's fully allocate pretty much everything. I want to see detailed granularity of what the cost impacts are at that low level. And then there's others that say, look, you shouldn't be allocating everything. It's pointless. You're just pushing dollars around. I fall somewhere in the middle. I do think there are use cases to allocate certain things down, especially once you start to break them into controllable, non-controllable buckets. It does facilitate better decision making. And that way you can make sure that you hold the right people accountable for the right things. Because at the end of the day, if we're holding people accountable for things that they have no control over, it does create stress within the organization. and it ends up with a biased forecast as opposed to an unbiased forecast. Next, it boils down to automated cost recovery. Are we building in automated price adjustments based on what the inflation models say? Now, we can go based off of CPI, we can go based off of the Fed, we can go based off of what the Treasury impact or what the forecasted impact is going to be from Treasury. There are a number of ways that we can do this. How you set your assumptions and how you're going to dictate that is something which I think you need to have as a discussion internally within your organization. But building in revenue adjustments and pricing adjustments, I think, is very important, or at least an important option to consider. Being able to understand the direct versus indirect cost impacts is going to be equally important, because if you see that your direct costs are increasing, you might need to go ahead and reevaluate your pricing strategy. If your pricing strategy is fixed, do you need to redo your business plan if inflation ramps up or down? It's going to be incredibly important to understand how cost recovery is going to impact your business. And the less that you have is one-off analyses, and the more proactive that you are, the more productive that your organization is going to be. You can start making sure that you are evaluating this in case the demand impact is not necessarily going to influence the overall inflation in the market. And as we start to think about how all of this fits together, pricing is just one element, and being able to arm executives with the right decisions and being able to adjust pricing to tell that story is very important. Next, we start to talk about year-over-year analysis. And the next two items, both this one and driver-based and predictive, are equally important. They're really tied to the hip together. Ideally, what we would do is start to treat the overall sort of inflation impact very similar to FX. Constant dollar reporting is a mainstay in organizations today. And the theory behind it is, let's make sure that we remove all sorts of dollar impacts and rate impacts to what our operational bottom line is, right? Let's take, and most organizations say, let's restate last year and this year's numbers. Other organizations say, I want to keep my historicals as historical, and I want to restate this year and last year's numbers. But the idea is the same. You may need to start thinking about how you want to treat this from an FX or from an inflation perspective, if it's similar to the way that you do FX. Removing noise is incredibly important. Telling the right story is important. Having the right narrative is important. Because at the end of the day, we want to get down to action planning. That's what it all boils down to. And the more clear and transparent information we have, the better off we're going to be. And next, with the lens of removing noise, how do we remove noise to enable driver-based planning and predictive? If we're growing based off of last year, does that really make sense in today's day and age to say we're going to grow by 4% or 7%? Realistically, in my opinion, the answer is no. I think that what we would want to do is make sure that we have an inflation adjustment, and then we also have what is an organic growth adjustment? What is an acquisition adjustment? Breaking those sorts of adjustments out is going to be very helpful to remove this noise. And as we start to look at predictive, and I mentioned this a little bit earlier, but predictive planning requires you to have data which is consistent. It's normalized, it's telling the right story. If you have significant numbers of outliers in the way that you're doing predictive planning or driver-based planning, it's going to end up creating a highly skewed forecast. Now, to me, the hardest part about having an accurate forecast is making sure that you understand when it's inaccurate. How do you identify when it's not telling the right story? And one of those things is making sure that you're removing outliers. So being able to remove months from, or the entire year from COVID is going to be helpful. Being able to normalize inflation is going to be incredibly helpful. And how you're doing that, especially because inflation can impact different segments in business lines and geographies differently, that's going to be something which I think you all will need to consider. So There's some other modeling opportunities as well. And this is really sector specific and industry specific because not all organizations are going to have the same impact here. But when we start thinking about an overall solution, it boils down to a few things. One, we need to make sure that we cover the entire office of the CFO, right? So not only traditional corporate FP&A, but what sort of operational FP&A questions do we have to answer? What are the supply chain impacts, right? If we're a heavy manufacturing type organization, where that is either our entire business model or it is a large subset of the business, what are all of the balance sheet impacts? Same thing with treasury. Like, what are we doing from a treasury perspective to make sure that we can enable treasury within our applications? And how all of this boils down is a few different areas. First, how are we solving purchase price variances? Obviously, depending on what happens with inflation, we might have to completely adjust the way that we're doing modeling. And being able to tell that story of why we are not making our budget and it's growing and it's skewing even higher on a month-to-month basis is a very important story to tell, right? So purchase price variances and other supply chain costs is something that you should probably consider in how you're going to leverage that. Now, most organizations don't really do balance sheet at a very detailed level. So this might be at a total company for you. This might end up being regional. Whatever your strategy is, it works, but this is one thing that you might want to consider. The second area is going to be interest, income, and expense, right? So those items are almost always input only from Treasury. Perhaps you can go ahead and automate that and make it simple and driver-based as opposed to outsourcing the entire thing from Treasury. Automating that might be helpful. Maybe you want to include different things like asset category and percentage breakdowns and how your portfolio is looking, as depending on what your loan structures look like. Maybe you want to be able to have a fixed rate component to that versus a variable rate component to that, and have a couple stat accounts to facilitate that. And then finally, again, depending on your organization and how large you are, you might need to start thinking about how you're doing gain loss modeling. The vast majority of organizations, and I would probably argue 95% or more, have this being as a straight up input from Treasury. And you can automate this. So depending on what your asset portfolio looks like, you might have significant mark-to-market investments that either get marked up or marked down, depending on what exactly is happening. So for example, if you're a heavy bond holder, right, and you're holding US Treasuries with the interest rates going up, you have a very significant loss in what those bonds are, which obviously impacts your bottom line. If you are in a rental space where you hold a lot of assets in your, you have a guarantor set up for how your creditors are effectively expecting payment, those are oftentimes tied to what your depreciation schedule looks like. So during certain events over the course of the past few years, there's been significant inflation of assets, which has actually reduced the total amount of depreciation that was required to be paid by to the creditors, right, based on those loans and the calculations. This might be one of the things that you include as you start to evaluate what your inflation strategies are. Are you looking to potentially renegotiate your contracts with your creditors to be based off of deflation or based off of the depreciation of what the total asset value was? Because if in some instances on a year-over-year basis, significant numbers of depreciating assets actually increased in value, which might significantly alleviate the depreciation that you have and the payments on those particular assets. So moving on, considerations, right? And so from a strategic lens, how are we going to leverage the inflation models in the upcoming budget cycle? We need to truly understand what questions that we're going to be facing. What is the transparency that we should be providing executives? Next, do we want the ability to isolate and reclass inflationary adjustments for management reporting? So we can treat this very similar to FX impact reporting with constant dollar. Perhaps what we want to be able to do is track inflation impacts and inflation rates by direct versus indirect, maybe different types of rate or asset classes and how they are responding to the different inflation rates. And we're actually going to be addressing that from an overarching perspective in a few minutes. And then not lastly, but one of the last items is, do we have a hedging and cost recovery strategy? Is it published? Do the stakeholders agree? Do we need to spend an exorbitant amount of time actually doing reconciliation between what our pricing impacts were? What is the adjustment? How are we facilitating this? And are we creating an unreasonable burden on FP&A by leaving this manual? The system can help you with a lot of this, right? And so when I mean the system, of course, is the Oracle EPM Cloud tool. Now, as we start to understand how we're going to be doing this, how do we want to report this to the street? How do we want to report this to various creditors? Do we want to treat this as an EBITDA add back? Because if in theory, we have gain loss on FX being a common add back, and that is standard, is gain loss on inflation also a common add back? That is a question that we should be asking ourselves in operational and strategic meetings. How do we want to treat reporting on this? How do we want to communicate this to the street? What is the best way for us to be able to communicate with our equity holders, with the analysts, and with any creditors that we have, right? So truly understanding what our strategy is from a reporting lens is going to be incredibly important. Now, implementation possibilities. We have a best practice application here at NOAPS, and I think it's very important to be able to understand what something could look like and what the modeling could look like. So now that we've talked about the vision and the strategy, let's talk about how it might manifest itself in the application. So first and foremost, we need to think about, what is the modeling going to look like? What are the different types of impact that we have? Do we want to track this on a total basis, right? On an annual level. So for example, we can set the inflation rate for a particular year. And this is actually leveraging an ePBCS application. The design for this can absolutely be standardized from company to company, depending on what tool that you're actually using. Now, the interesting thing about the out-of-the-box modules, right? So ePBCS, the enterprise version of planning and budgeting, they all have very similar constructs and data elements. So how you implement this is quite standard from client to client. How I would probably recommend is to start having conversations around how inflation is impacting your business. Do a little bit of statistical modeling, identify what are the commonalities and what is the appropriate level of detail to capture this at. Do you need a commodity inflation rate? Do you need different types of inventory that you're going to be applying this to? Do you want to create an overhead rate? And then finally, as we start to understand this, we need to really understand what the time impact is going to be. Is it going to be real time? Do you have contracts where you've locked in a price? Should you lock in a price on your contracts to account for inflation? Is that going to help your organization? If we go back to one of the most important case studies on this, and it was highly helpful for them in certain instances, in others, they ended up losing a lot of money, is Southwest Airlines. Southwest Airlines, and this is a very widely published case, they actually had locked in the price of fuel for multiple years. And during the period of time where the price of jet fuel had effectively skyrocketed hundreds of percent, they locked in what their pricing was way earlier. And so it saved them a lot of money, many, many millions of dollars, and many articles were written about it. Now, in other times, they did not necessarily make money off of their hedging, but hedging is an important aspect. And how you are actually doing your hedging should be tied to how you are tying inflation into your overall budget and the level of detail there. So as we start to think about various overheads, let's talk a little bit about ones we know have a lag. So for example, rent. Rent is one of those where we know that we have a lease for 12 months, 18 months, 5 years, 30 years, whatever it is. If we're going to be applying inflation adjustments, do we truly want to factor in inflation on our rents? Do we want to factor in inflation for energy costs? Do we want to factor in inflation on P&L, balance sheet, wages. Does it make sense? Now, I think it's easy to over-engineer what you're trying to do here. I don't think that you have to do that. But at the end of the day, all we want to do is come up with the level of detail that works for an organization. And that level of detail really needs to be decided based on how your organization works, right? What are the operational questions that you're going to be asking and answering? So first, we need to define the inflation assumptions by category, and then we need to figure out the timing of when these are going to be. Now, do I think that we have to set this on an account by an account basis, as we see here on the right-hand side? I don't think it's absolutely imperative to do that. I think that this is a distinct possibility by account grouping. Maybe you want to have direct, have a 3-month or 6-month lag. Maybe you want wages to have an annual lag. In very high inflation environments, so for example, Venezuela, in Argentina, there needs to be monthly adjustments that you make, right? So how you're doing this, especially if you're a global firm where you're doing business in many countries where inflation absolutely may start to require that, this sort of model is going to be highly beneficial for you. And it becomes pretty straightforward because once you actually have the monthly inflation numbers here, you can figure out what that looks like and apply automatic price adjustments to either your costs or your revenue or whatever the situation might be. You can tie this to pretty much anything that you can think of. So now the interesting thing behind this is once you start digging into automating this process, what do you want the modeling to look like? You absolutely can make sure that you're providing the right level of detail. So if we kind of go back all the way to the start here, what are some of the things that you want to capture? Do you want to have a specific controllable versus non-controllable lens into how you're setting these inflation adjustments? What are the different use cases that you have for automated cost recovery? Are you going to allocate this or not? Do you want to have inflation built into price volume mix? Which segues perfectly into the next section, which is how are we doing things like price volume mix with this sort of inflationary environment that we're in? Now, this is a sample way of being able to do price volume mix. Now, for the technical people on the call, this is really leveraging the plan element dimension. You can have this be prior year budget, so that way you have a really easy way to analyze this. You can do this on a month-to-month basis or a total year basis. You can do this based off current year, next year, prior year, whatever makes sense to you. You can even have different impacts from a walk to say, here is the budget, here is the forecast. And what components of our price volume mix is attributable to pricing? What is the change attributable to volume? What is the mix change that we have? What is the inflationary adjustments that we have? How are we handling discontinued products and rebates? And of course, you can start to factor in, this could just be net inflation overall across your organization. Maybe you don't want to be able to have multiple inflation buckets or a single. Maybe you want to have 5 different inflation buckets, depending on how your P&L is broken out. Maybe you want to have different reporting from a balance sheet lens. All of these things matter, right, when we're telling a story. And it boils down to, at least for me, how would we be able to take a look at this from a waterfall perspective? Is it easy to tell that story? Now, waterfalls are something, there's waterfall charts that you can actually build in management reporting now, which is one of the newer web-based tools that replaced old Financial Reporting Studio, FRS, and those come out of the box. So as you start to think about the technical implementation of these different concepts, this is one of those where the design will directly impact and influence how you can do this on an automated basis. So now, although this was a single lens into how we could do price volume mix reporting, this is just one different lens. There's many different ways that you can do this. So you can actually take a look and figure out how you want to represent this cost from an overarching perspective, right? And so as we start to think about pricing adjustments from an automated lens, and we're only showing 2 here. We're showing inflation costs and an inflation cost recovery. So you can see here, based on this particular view of a P&L, you can see that the inflation cost recovery that you have, itchy nose, is approximately net negative from a 4 million perspective. Now, this is not even factoring in any mark-to-market gain loss on things like the different asset classes that you have. If you're a significant holder of US Treasuries, what are the actual impacts that you're experiencing from a total bond perspective? Do you need to reference that? Do you need to build that in? Is that something that you want to factor in? Are there other items that you should be factoring in from a risk and opportunity perspective? So what do I mean by that? Risk and opportunity reporting is something that I am a big fan of, in being able to now say, well, we have actually locked in our interest rates, and so we have a significant risk next year, but it's we have a significant opportunity to be able to try and fix it, right? There's many different angles that you can approach this from. If you know that you're having significant interest rate savings in how you're doing things based on what your credit facilities are, that's something that you may want to establish here as well. Maybe instead of having a single inflation cost bucket, maybe you actually want to be able to break that into direct and indirect. Maybe you want to show wage inflation. Maybe you have an inflation specific report. Maybe you don't necessarily care about the different buckets here, but coming up with what your strategy is to handle inflation is going to be extremely important. And it really starts with trying to figure out the questions that you're going to need to answer throughout the course of the year as you transition from business plan to forecasting and then finally action planning. So I hope everybody found this valuable. If anybody has any questions, I'd be happy to field them.
Thanks so much, Matt. That was great. A lot of great information in there. So while you were speaking, we did have a couple of questions come in, so I'll go ahead and ask those now. And as a reminder, if anyone else has additional questions, please go ahead and type those into the questions box so we can get those answered for you. So the first question that we got, Matt, was, is there a difference between how you can handle this in a custom PBCS application versus the ePBCS modules?
Good question. I touched on that a little bit earlier, but the details behind it are pretty straightforward. So most clients that are on PBCS with a custom built module are still implementing a lot of the best practice dimensions. So the way that ePBCS applications will handle it is going to be identical, effectively from client to client, industry to industry, because the way that organizations are working and are leveraging the tool with the standard design, it becomes very simple. If your organization has a similar, we'll call it data element, to plan element, which is the out-of-the-box dimension, then you can leverage almost the same sort of impact and the same sort of design principles. It doesn't mean it's going to be identical, but I would say 95% of organizations share the same overall design concepts. Now, last comment on that, as we start to think about different sectors, different types of organizations, specifically municipalities and higher education, are going to require a different design, especially as you start to branch outside of the US. But those are really the nuances, and if you wanted to be able to kind of understand how that would work, we would probably need to have a follow-up on that.
Okay, great, thank you. The next question that we got was, are there any specific crossovers between how you're handling FX rate fluctuations and inflation, or are they one and the same?
That is a very good question, and it's very complicated. The short answer is I would recommend that organizations that are, we'll call it, not necessarily very mature in how they're handling certain modeling around that to stay basic, right? Keep it constant dollar, remove the noise, and just start to view it at a total percent level. If you feel that you're very advanced, if you feel that you have a really good grasp on how inflation is going to impact your overall business model, absolutely treat them separately, because you can get very, very automated and very advanced with a lot of different assumptions, and break it down into balance sheet assumptions, P&L assumptions, You know, you can even start doing it from a different lens, from a treasury and a supply chain perspective, as opposed to just operational FP&A and revenue and pricing impacts. But overall, my recommendation would be to try and keep it simple. Simple is good. And it just means that you may not necessarily have all of the answers at your fingertips without further analysis, you know, when you start to kind of engage with stakeholders and executives.
Great, thanks so much. So I'm being conscious of time here. I know that we're coming up to the end of our session, so I'm gonna call it on asking the questions, but for anyone who asked a question that we did not answer at this time, we'll reach out and follow up directly with you with an answer. So if there are any additional questions that you didn't have a chance to put into the questions box, or if anything after the session comes up that you would like to discuss with us, please use the contact information that you can see on the screen here, and we'd be happy to have a personalized conversation with you regarding inflation modeling. At this time, I want to thank you all again for joining our webinar today. I hope you got a lot of value out of it, and have a great rest of your day. Thank you all.
Thanks, everybody.